Today, the show's Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrell Wealth. And today we're very excited to be able to have an advisor really on the tax side of tax rates and basically what's going on out there in the world. I wanted to be able to bring to you guys a chance to really kind of learn about what the landscape looks like out there here going into the election and whatnot. The show is Money Matters with Greg. It's a financial literacy show about finance, anything to do with finance. And we are always privileged and very, very flattered to have some great guests on this show in regards to some of the people that we meet. I've always wanted to be able to have maybe be a fly on the wall of a conversation, some of the conversations we have. And we're lucky enough to have as financial advisors in the wealth management space with clients all over the nation. We just have some really, just some cool conversations. And sometimes we have these conversations and I just say, you know what, hey, if you're interested, would you want to be on a podcast or want to be on the YouTube channel? And that's exactly what we're doing here today. So I want to apologize for, we're not going to apologize for my attire today, but I'm on my way to a high school football game this afternoon, tonight. So very, very excited about that. So I'm in my colors, my Culver colors, and very excited to be able to, so if you are on YouTube, you're seeing some fandom here. We're excited to, COVID aside, get to watch some sports here for the first time in the Midwest. I'm very excited about that. In regards to today, we're going to want to talk taxes and how are tax rates going to affect your future and maybe your future planning and maybe even as a business owner, exit planning. And today, I really wanted to welcome Jeremy Huish, who's Director of Business Transition Advisors, and it's a division of Capstone Headwaters out in Arizona. Jeremy's responsibilities include business development, corporate reorganization, finance, succession planning, consulting, and ESOP implementation. A lot of stuff that he does. He's got experience as an attorney. He's a CPA. I've known Jeremy for a number of years during when we used to be affiliated with captive insurance groups. He's not affiliated in any way with LPL Financial, or any of its affiliates, but he's a really, really smart dude and really, really good with spending over 7 years in DC as a tax attorney for a big four accounting firm. And today, just want to welcome in Jeremy Huish.
Hey, Greg, thanks for letting me be here today. Some exciting things happening, so glad to talk about it.
Thanks so much for being here. I wanted to talk about how higher tax rates could affect planning, and you've got a really good sort of a paper news flash that you actually put out, and it's on your website, businesstransitionadvisors.com. So make sure to check that out. All the listeners out there, make sure to check out businesstransitionadvisors.com. And you can find Jeremy also, it's Huish. You can find him on LinkedIn. You can obviously reach out to him on the website. But the executive summary and sort of the things that you did in this summary is talking about business individual tax rates are likely to go up in the future. What are you seeing out there in regards to what's trending in regards to tax?
Oh, sure. So everyone knows that there is an election coming up this November. And everyone also knows that the federal government has spent a lot of money this year stimulating the economy. Well, I've taken a few accounting courses in my life, and it's not too hard to figure out that the government somehow, both federal and state and even local governments, are going to have to raise up some money to fill in that hole. One way or another, they're going to have to raise revenues. Now, we know that one of the political candidates, Vice President Biden, has put out many of the facets of where he proposes the tax policy will go. President Trump hasn't put out his where he thinks it needs to go. But one way or another, I think both of them are going to be forced to, maybe not the first day of their next season of office, but they're going to have to raise income. And the best place to do that is to grab income from the one percenters and the business owners and corporations. And so I'm seeing higher tax rates. And I wrote an article there about at least what we know right now is Vice President Biden's proposal, how he's raising certain rates from here to a higher amount. And I wrote a paper about that. So I'm happy to, would you like me to go into a few of those proposals that he has?
That'd be great. Thanks. Bring it on, Jeremy. What you got?
Okay. So for example, federal corporate tax rate was dropped from 35% to 21%. Now it's being proposed to go from 21% to 28%. That's a 33% increase in tax rates for corporations. The ordinary income tax rates for the highest individuals right now is at 37%. Is going to go up to 39.6%, which is a 7% increase. The federal capital gains rate, this one's huge. Right now it's 20%. If you add in the Obamacare tax is 3.8, but it's 20% right now, and that's going up to 39.6%, which is almost doubling that tax rate. It's a 98% increase. And other things are all in the proposal as well, such as the 1031 exchange deferral may go away for real estate investors, and estate planners would be paying attention since the step up in basis at death may go away as well. And so all this is happening, and there will be zigs and zags when it goes through Congress, and how that's going to be, and lobbying will go and try to defend their prize tax loopholes. But at the end of the day, the tax gathered must be greater to pay for all this debt that we've taken on. And as I looked at this and said, well, what's the largest transaction that a business owner does their entire career? You know, it's not selling a few widgets or bringing on a new customer. Usually the largest transaction of their entire career is when they sell their business. And when you have a 20% tax rate on capital gains versus a 39% tax rate, there's a huge difference there. And we're fortunate to have a few months of timing to say, hey, those rates haven't started yet. And maybe we want to do some changes now, or do some planning now to take advantage of this lower tax rate before January 1st comes around, and potentially nearly double the tax rates on certain things.
So are you seeing, I mean, you really, as a business owner, you need to be contemplating, you know, if you are contemplating selling your business, it's something that really is timely in regards to this year, right?
That's right, Greg. It's timely to this year, and it's not something you can just turn on a dime the last few days of this year, or even wait until after the election and say, I'm going to wait till November 3rd, November 4th, 5th, and let the exact election settle, and then make a decision, because there's going to be a traffic jam of all the bankers and the lawyers and the CPAs trying to get all the planning done. And if you're trying to get the highest and best price and the best planning done, it's prudent to start your maybe some contingency planning now. And then you can wait to see whether you pull the trigger until after the election. But you want to start now getting some things in place, getting the lawyers and getting the transactions prepped. Otherwise, you're going to run out of time before the end of this year.
In regards to business valuation too, don't you really have to sort of get, I mean, obviously you have to get moving on this as soon as possible if you're interested in doing it this year. So the business valuation, no, we have a business valuation software company that we outsource, that we use in Biz Equity, and they do a really nice job to get sort of a number for business owners. But there are more, robust certifications or certified valuations in regards to what a business owner needs to do, is getting a valuation that is certified. What does that entail? Because that's basically a lot of what your business is.
Yeah, this is you may not think about it, but if tax rates go up, it can have a decrease in value on your business, because when you're doing a robust business valuation, something that will be respected for the IRS upon audit, or that a third party would do if you're being bought by a large strategic buyer, they're going to look at the income approach, market approach, asset approaches that they have. But ultimately, a lot of it turns out to is how much cash flow, how much profit will that business generate? And if the business is generating, I'm just going to use easy numbers, $1 million in profit, and it has a 21% tax rate, that means that there's $790,000 of cash flow flowing up to the parent or whoever buys it. But if taxes go up to 28% or higher, well, that means there's less cash flow, which means the business is going to be worth less to the buyer. Now, when the 2017 tax reform came about, this was just 2 or 3 years ago, we saw our own clients, just because of the tax rate drop, we saw their value of their business drop or increase from 7 to 15%, just because of lower taxes, more cash flow, higher business valuation. And the stock market also reflected that as well in the 2017 and the 2018 run up in the stock market. Because of the lower taxes, we know the prices went up 20, 30% in some cases. And so taxes will have an impact. Maybe not on all businesses, and it won't be the same across the board. But when you're doing a robust valuation, and we have in-house valuation people at our firm, and we've been doing this now for 20 years, but we have a robust valuation that looks at cash flow, the amount of taxes that are eaten up by profits will affect the value of a company.
The example,
Which means if you're trying to get the highest and best price for your company, you may want to look to get the sale. If you have the choice between selling it this year versus next year, and you have the same buyer, the same price, the buyer is going to look twice at that next year and say, maybe we need to drop it down because you're producing less cash flow, because now they know for certain what the taxes are. But if you go this year before taxes are set, you're going to lock in a contract price at the higher tax rates before potential taxes will change.
Perfect. And in that example you're talking about, with 21 going to 28, different state numbers that are out there, but I mean you were looking as much as between 7 and maybe 12% decrease in value just based on tax.
That's right. That's right. That's a large amount. So that's not even your individual tax that you pay on that afterwards. That's just on the sales price that they'll give you for it.
Right. Very well said. Anything else that potentially a business owner looking to sell might want to consider in regards to? I know it's here it's already August, so it's going to be very difficult to obviously find a buyer and get all this done and whatnot. But as far as the future goes, nothing's set in stone. We'll see what happens with the House and the Senate and everything else as far as what's going on in the election. But what else can a business owner do to mitigate their tax liabilities, as an overall business?
Oh, sure. Well, there's a few of them. One of the common, and now I don't do normal CPA practice, but I work with a lot of CPAs, and one of the common rules of thumb that they use for just general tax and accounting planning for their businesses is they say, look, we try to accelerate expenses and delay income at the year end. And that way we can push off income to the next year. But this year you may see that flipped. You may see CPAs advising to accelerate income and delay expenses because you want to show as much income this year as you can at the lower 21% or whatever rate it is as a business, and then push expenses into a following year so that those expenses are worth more because of the deduction that you get there. So that's one I think is going to be a little surprising to businesses when they're so used to pushing income into the following year. Come December, their CPAs are going to have a different type of conversation with them. And that's going to be from everything from buying office supplies to large purchases and when you invoice your customers, and certainly you want to follow all the accounting and tax rules, but that's something to be prepared for now for just some of the more block and tackling accounting work that's done. Now, but comments on that, Greg? I mean, there's some other ideas too that you could think about for tax planning before year end.
The show's Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrell Wealth, and it's a wealth management firm that's local here to Valparaiso, Indiana, and the Midwestern charm that we have in this wonderful town of Valpo. But it's just outside Chicago. But we have clients all over the nation, and we talk with all these different clients about multiple different things in regards to holistic wealth planning and wealth management, investments, insurance, and tax and debt, and all these other things, and just put them in touch with basically a team in regards to being a virtual multifamily office, trying to help business owners and high net worth families really plan for all of these different things. And you can find us on YouTube, on our YouTube channel at Farrell Wealth. You can find us on Twitter, as Facebook and LinkedIn. Reach out at any time in regards to this show and the Money Matters with Greg podcast, or on Spotify and iTunes as well. Just search Money Matters with Greg. We're also extremely privileged to have some great guests on this show. And today, when Jeremy Huish, as Director of Business Transitions Advisors, which is a division of Capstone Headwaters out in Arizona, talking about taxes. So really excited to be able to have Jeremy on today. And thanks for listening for everyone out there. I wanted to sort of pivot a little and talk, and I know you could do your own show on this for months and months and months and many episodes, but is there a way you can kind of just sort of talk about, for the listeners out there, of and some of the business owners out there, the advantages or some of the things you do in regards to ESOPs. What is an ESOP, and what is the industry doing in regards to much of this, less taxes, minimization of taxes in regards to the landscape out there?
Oh, sure. Thanks for the opportunity. An employee stock ownership plan is one of the options that a business owner can choose to go if they're trying to say, who should I sell my business to? They could sell it to a third party buyer, they could sell it to their children, they could sell it to key management, but they can also sell it to their own employees and sell it to this thing called an ESOP. Now, ESOPs have been around for decades. They're in the tax code, they're governed by the IRS and the Department of Labor. And it's much like just a jumbo 401k that doesn't invest in the normal stock market. It invests in the business stock of your own business that you're working in. And it has some great tax benefits that Congress has given it. And so what it allows you to do is to sell your company at fair market value to your employees, but the employees pay nothing for it. The business ultimately pays it with tax deductible dollars. So it's very efficient for the business. After they bought you out as the business owner, they then give the employees the business stock at no cost to the employees. Usually it's allocated over a certain number of years, but the employees become owners. And what's great about this is it's favored by both Republicans and Democrats in Congress. Senator Gillibrand's in favor of them. She just passed a law recently that helped out ESOPs, and the Republicans like it because some of the tax benefits. But an ESOP is a great tool for that. Now, there's some interesting tax benefits that come to the seller. When you sell your business to an ESOP, the owner of the business can elect a 1042 election, which will defer the taxation and potentially avoid on the gain of that sale. So let's say you're going to sell a $10 million business and you can go sell it to someone down the street. You may pay 30% tax on that between federal and state cap gain. So you end up with $7 million in your pocket. If you go sell that same $10 million business to your employees through this ESOP, again, they pay nothing for it. It's just paid for by the business. You can make this election and wind up with $10 million in your pocket and not have to pay any tax on that and just defer it all out. And there's some exit planning strategies with there. So there's powerful ESOP tools for the business owner. It's better for the business itself because there's less debt load it has to take on. It's easier to finance. And the employees love it. And I mean, we could spend some time on what the employees mean because there's some wonderful stories. If you like, I can share a couple stories about what it does for the employees, but it's awesome for all three of those groups.
Yeah, please do. I mean, it really does add a fair purchase price. It protects a legacy in the business. It benefits the employees. There's definitely something to look into. It's, obviously we're not recommending in any way, what we are recommending is you get good counsel and you reach out to Jeremy and his advisors out there to be able to have conversations about maybe this might be something that is a fit or not. But yeah, if you've got a couple of, an example of something as far as the employees goes, have at it.
Oh, sure. So probably one of the more famous ESOPs out there today is Winco Foods. Now, Winco got started in their ESOP 25, 30 years ago. It's just a grocery store. But they brag that they can sell their groceries for cheaper than Walmart, make more profit than Walmart, and pay their employees better than Walmart. And why can they do that? Well, they say part of the reason is because they pay no tax and they're employee owned. And that's because of the way the ESOP structure is built for them, is they don't have to worry about corporate taxes. It's all wrapped up into this ESOP and the employees are now vested in it. And you can go Google Winco Foods and grocery store baggers and you'll see stories of, I like one of them. It's about two sisters. One started at Winco 25 years ago. The other one started at a competing grocery store. And then they tracked their progress. And over 25 years, the one that stayed with Winco has over $1 million in her retirement account. Now, this is a grocery store bagger, not the manager, not the head person of the store, just the basic entry-level job, and still kind of in that type of role, but close to $1 million in their retirement accounts by working at Winco, versus her sister that started someplace else and bounced around to some other jobs, just has just a normal, in their late 30s, 40s, just normal amount of retirement. I think it's like $50,000, $60,000, $70,000 that person had. So it's a night and day difference because Winco takes all of their savings from taxes and dumps it into the profit, and that goes to the employees. And so if you as a business owner want to change the life of your employees, I don't know of any other way to do it other than you put it into an ESOP, and you can now change their retirement for better. We've done statistics and done studies from the ESOP Association that the retirement plans on average, now Winco is an outlier, that's admittedly higher than average, which you can see with millions, but that's not a one-off. But the average employee retirement account within an ESOP is 2.5 times greater than a competing employee at some other business. And so that 2.5 times is night and day with how your retirement's going to be. So there's other examples like that, but Winco Foods, you can Google it, it's out there. And but it's amazing what you can do when you're not paying taxes and sending all the tax monies to your employees' retirement accounts.
Perfect. Jeremy Huish, Director of Business Transition Advisors and Division of Capstone Headwaters. You can find him at jhuish, it's Huish, at capstoneheadwaters.com. Reach out to him if anything, you got any questions about anything we've discussed today. Any final thoughts, Jeremy, you want to leave with the audience with on exactly what we talked about? We talked about higher tax rates and what's going on as far as the landscape, and a little bit about ESOPs. Anything else you want to be able to mention just as we part here?
Yeah, it's an exciting time. I just say talk to your financial and your tax advisors. And if I can be of help in what I do, happy to chat with you about it. So thanks for the opportunity, Greg.
Thanks for being here, Jeremy. That's Jeremy Huish with he's Director of Transition Advisors, and it's a division of Capstone Headwaters, like we mentioned. You can find us on YouTube. You can find us on Twitter, LinkedIn, and Facebook. Reach out to Jeremy as well. I hope today was some sort of value to you and yours. I hope that everyone has a healthy and profitable week and looks forward to planning here as we move forward into the end of the year and the final quarters of a very difficult and trying 2020. I'm sure we're all excited to be able to put away 2020 to bed. But in the meantime, you might want to plan ahead and try to start thinking about what's coming down the line here in regards to taxes. So that's our mission today, is to be able to let everybody know that you might be, it's all about the plan. My father always used to say, make the plan, work the plan. And that doesn't change here, even though we're dealing with a pandemic and everything else that's going on in the world. So reach out to your advisors. Obviously, get your team together and try to think about some of the things that you might be putting together by the end of the year. Again, hope everybody has a healthy and profitable week, and we'll talk to you on the next show. See ya. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Farrell Wealth and subsidiaries are not affiliated with Business Transition Advisors or Jeremy Huish in any way. Farrell Wealth specializes in wealth management and retirement plan governance assistance. LPL Financial and Farrell Wealth are not affiliated with Business Transition Advisors or Jeremy Huish and do not represent or endorse the accuracy or reliability of any advice, opinion statement, or any other information displayed or distributed through them. You are under no obligation to utilize the company.